It's 2 a.m. in New York, but on the screens of the Shanghai Gold Exchange, the sun is already burning. Look at this spread, right here. At this exact second, a kilogram of physical silver in Shanghai is trading for a $6 premium over the spot price in New York. $6. In the world of high-frequency trading, where algorithms kill for a fraction of a penny, $6 isn't a gap. It's the Grand Canyon. By every law of free market economics, this shouldn't exist. Armadas of ships should be loading bullion in New York Harbor right now, sailing east to capture that risk-free profit until the prices equalize. It's called arbitrage. It's the gravity that holds the financial universe together. But look at the shipping manifest logs at the COMEX warehouses. Nothing is moving. The ships aren't sailing. The metal isn't flowing. The free money is sitting on the table, and the hungriest sharks on Wall Street are refusing to eat. Why? Because you can't ship what you don't have. We are witnessing the quietest default in history. The link between the paper price on your screen and the real metal in the vault has just been severed. Let's look at the crime scene. We need to freeze the frame right here. 2 hours ago, the chart stopped making sense. If you pull up the feed from the Shanghai Gold Exchange and overlay it with the COMEX data from New York, you see something that defies the laws of physics. We are looking at a $6 gap. $6. To the uninitiated, that might just look like market volatility or a glitch in the matrix. But to anyone who understands the plumbing of the global financial system, that gap is a screaming siren. It means that an ounce of silver sitting in a vault in Manhattan is valued at roughly $30, while that exact same ounce of silver, if it were sitting across the ocean in Shanghai, is worth $36. That is a 20% premium. In the world of high-frequency trading, where algorithms will fight to the death over a fraction of a penny, a 20% risk, free margin is not an opportunity, it is a black hole. It sucks everything in. Under normal circumstances, this triggers a mechanism called arbitrage. Arbitrage is the gravity of finance. It is the force that keeps the universe together. It is very simple. If water level is high in one tank and low in another, and you open a pipe between them, the water flows until the levels are equal. If silver is cheap in New York and expensive in China, traders buy in New York and sell in China. They buy low and sell high, and in doing so they push the New York price up and the Shanghai price down until the gap closes. It is free money. It is the easiest trade on earth, and usually it happens in milliseconds. But look at the screen. The gap is not closing. It is widening. The water is not flowing. The pipe is open, but the tank on the left is not draining into the tank on the right. This is where the story stops being about numbers and starts being about structural failure. We are witnessing the death of arbitrage. When arbitrage dies, it means the market is broken. It means the price discovery mechanism, which is the very heart of capitalism, has stopped beating. Think about who usually executes these trades. We are not talking about retail day traders in their basements. We are talking about the bullion banks, the giants, the names on the skyscrapers. They have the vaults. They have the logistics networks. They have the armored transport contracts and the insured shipping lanes. They exist to eat this kind of spread. It is their bread and butter. So why are they starving? Why are the sharks not eating the chum in the water? There is only one logical explanation for a trader refusing free money. It is because the trade is impossible to execute. You cannot ship what you cannot possess. This brings us to the terrifying reality of the paper markets. When you buy silver on the COMEX at $30, you are not buying a bar of metal. You are buying a promise. You are buying a contract that claims to represent a bar of metal. But when the price in Shanghai hits $36 and you decide to convert that paper promise into a physical bar so you can put it on a plane, and sell it for that massive profit. You hit a wall. You find out that the inventory is not there. Or if it is there, it is encumbered. It is leased out. It is rehypothecated. It belongs to 3 different people at the same time. We are mapping a new financial geography here, where the old maps no longer apply, and the terrain is shifting under our feet every single hour. If you want to track these fracture points as they happen and understand the mechanics of the collapse, rather than just watching the dust settle, make sure you are subscribed to this feed. Because we do not just report the news, we dissect the anatomy of the system. The bullion banks know this. They know that the price on the screen is a fiction. They know that if they try to drain the COMEX to feed the hunger in Shanghai, they will break the exchange. So they sit on their hands. And that $6 spread sits there like a monument to their insolvency. It is proof that the Western price is artificial. It is the price of a ghost. Imagine walking into a car dealership and seeing a brand new Ferrari listed for $10,000. You would think it is the deal of the lifetime, but then you try to buy it, and the dealer tells you that you can pay for it, but you cannot drive it off the lot. You can only sell your receipt to another guy in the lobby. That is the COMEX right now. The price is low because you cannot take delivery. The price in Shanghai is high because that is the cost of actual reality. That is the cost of metal you can hold in your hand and drop on your foot. So here is the question that should keep you up at night. If the price of gold and silver in the West is $4,650 or $30 or whatever the ticker says, but you cannot actually get the metal for that price, then is that the real price? Or is it just the price of a ticket to a show that has been canceled? We are looking at a store with empty shelves that has forgotten to take down the sale signs. This is not a market correction. This is a supply chain trying to tell you that the warehouse is empty. Before I show you exactly how this drainage mechanism works and run the simulation of what happens when the last ounce leaves the West, I need you to calibrate your expectations. I need you to decide why you are here. If you clicked on this video looking for a ticker symbol or a price target for tomorrow morning, or some kind of get-rich-quick signal for your options account, you are in the wrong place. This video will disappoint you. You should turn it off and go watch the cheerleaders on cable news. But if you are here because you feel that something is fundamentally wrong with the narrative, and you want to understand why the supply and demand curves you learned in school are failing in real time, then stay right where you are. We are about to open the hood of the engine. We have established that the arbitrage is dead, and the inventories are likely phantom. But knowing the machine is broken is not enough. We need to know what happens when someone tries to force the gears to turn. We need to simulate the run on the bank before it actually happens. Because if the West is truly out of metal and the East is insatiable, what happens when the Shanghai price keeps rising and the New York price keeps dragging? We are about to run a simulation that the central bankers are terrified to look at. Let us strip away the noise of the daily news cycle and run a strategic simulation. We will call this model the Siphon Simulation. To understand why a $6 price gap matters, we have to stop thinking like investors and start thinking like engineers looking at a hydraulic schematic. We need to isolate the variables and run the system until it fails. Step 1 is setting the parameters. In this simulation, we are placing a theoretical entity in Shanghai. Let us call this entity the sovereign buyer. This buyer is not a speculator. They do not care about the daily fluctuation of the US dollar index. They are not trying to make a profit in fiat currency. Their objective is purely physical accumulation. They need silver for solar panels, for electric vehicle contacts, for guidance chips, and for the strategic reserves of a superpower that sees a kinetic war on the horizon. This buyer looks at the global market and sets a bid. They say I will pay $36 for every ounce of silver you can put in my hand today. This is the siphon. It is a high-pressure vacuum pump turned on in the East. Under the old rules of the game, which governed the last 40 years of finance, this pump would trigger an immediate reaction from the West. This is step 2, the valve check. In a functioning market, the bullion banks in London and New York act as the equalization valves. When the price in Shanghai rises $6 above New York, these banks are supposed to open the vaults. They are supposed to take the silver sitting in the COMEX warehouses, load it onto armored transports, and ship it to Shanghai to capture that spread. This massive flood of Western supply would satisfy the Eastern demand, and the price gap would close. The pump pulls and the valve opens. That is how the machine was designed to work. But the simulation is flashing a critical error code right now, because the valve is stuck. To understand why, we have to look at a specific line item in the COMEX data that most analysts ignore. It is called registered inventory. You have to understand that not all silver in a COMEX vault is for sale. Most of it is what we call eligible. Eligible means it is just sitting there, being stored for private owners. It is not available to the market. It is not for sale at the current price. The only metal that can actually be delivered to satisfy a contract is registered. When we look at the data for registered silver, we see the reason for the failure. The tank is running dry. The levels of registered silver have been bleeding out for months, crashing to multi-year lows. The bullion banks cannot ship metal to Shanghai because they do not own the metal in the vaults. They are naked. The West has run out of ammunition. The siphon in the East is pulling with incredible force, offering a massive premium, but the West has nothing left to give. The dampening mechanism of the global price suppression scheme has finally run out of physical fluid. This leads us to step 3 of the simulation, which is the decoupling. This is the phase where the simulation predicts a fracture in reality. If New York cannot deliver metal to Shanghai, then the price in New York becomes irrelevant. It ceases to be a price and becomes a memory. Think of it this way. If you have a ticket for a concert that has already happened, the face value on that ticket does not matter. It is a souvenir. The spot price of silver on the COMEX is fast becoming a souvenir. It is a number derived from the trading of paper contracts between entities that have no intention of ever touching a bar of metal. Meanwhile, in Shanghai, the price is being discovered by the physical collision of supply and demand. We are entering a world with 2 prices: the paper price, which is managed, suppressed, and highly leveraged, and the physical price, which is raw, volatile, and significantly higher. The $6 spread we are seeing today is just the beginning of this bifurcation. As the registered inventory in the West hits zero, that spread does not just widen, it goes vertical. The simulation suggests that eventually the COMEX will have to change its rules to prevent anyone from asking for delivery at all, effectively admitting that it is a betting parlor and not a commodities exchange. Now we arrive at step 4, the stakes. Why does this matter to you if you are not a silver trader? Why is this a red alert for the entire global economy? Because pricing power is the ultimate form of imperial power. For the last half-century, the United States has enjoyed the exorbitant privilege of pricing the world's resources in its own currency. We decide what oil is worth. We decide what gold is worth. We export our inflation to the world by suppressing the price of real assets relative to the dollar. But if the pricing mechanism shifts to Shanghai, if the East becomes the only place where you can actually buy and sell physical material, then the East sets the price. And if they set the price, they control the value of the dollar. If Shanghai says gold is $5,000, then gold is $5,000, and the purchasing power of your savings just evaporated overnight. This is not about a bad trade or a market correction. This is about the transfer of the financial center of gravity from the Atlantic to the Pacific. We are watching the engine of Western financial dominance seize up in real time because it ran out of oil. The paper contracts that held the system together are burning up due to the friction of physical reality. The Siphon Simulation does not have a happy ending for the holders of paper assets. It ends with a default, not a declared bankruptcy where a judge bangs a gavel, but a technical default, where the product you thought you owned simply does not exist at the price you thought you paid. This is not a theory based on sentiment or fear. It is a calculation based on flow rates and reservoir levels. The math is absolute. When the drain rate exceeds the fill rate, the reservoir goes to zero. It is an inevitability of physics, not a probability of economics. But to prove that this is not just a simulation, we need to look at the fingerprints left at the crime scene. We need to look at the specific charts that show exactly who is trapped and how deep the hole really is. If our Siphon simulation is accurate, then we should be seeing stress fractures in the piping of the global exchanges right now. A simulation is only as good as the data you feed it, so let us leave the theoretical realm and look at the actual gauges on the dashboard of the COMEX and the Shanghai Gold Exchange. We are looking for confirmation of the leak. We are looking for the fingerprint of the vacuum. First, we turn our microscope to the Commitment of Traders report, or the COT. This is the weekly report that tells us who is holding what position. Usually we look at this to see what the speculators are doing. But today, I want you to ignore the speculators. Ignore the hedge funds. Ignore the small traders. I want you to look at the commercials. These are the bullion banks. These are the operators of the valve. In a healthy market, when prices rise, the commercials usually go short to hedge their inventory. They sell paper contracts to lock in prices for the metal they hold in the vault. But when we overlay the commercial short positions against the physical withdrawals happening in Shanghai, we see a divergence that shouldn't exist. While the price in New York has been capped and beaten down by massive paper, selling the physical withdrawal rate at the Shanghai Gold Exchange has gone vertical. This is the siphon in action. The data shows that for every ounce of silver entering the COMEX vaults, nearly 3 ounces are leaving the Shanghai vaults. The flow rate is negative. The pressure is dropping. The commercials are frantically selling paper contracts in New York to keep the price down. Because if the price breaks out, it triggers a margin call that could wipe out their balance sheets. But every time they slam the price down, they just make the metal cheaper for the siphon in the East to acquire. They are feeding the very beast that is eating them. They are subsidizing the accumulation of strategic assets by a geopolitical rival. It is a suicide loop. Now let us look at the inventory itself. This is where the forensic accounting gets interesting. If you look at the headline numbers regarding COMEX silver stocks, the exchange will tell you there is plenty of silver. They will point to a big number in the total inventory column and say, "Look, everything is fine. The vaults are full." But this is a sleight of hand. It is a magic trick designed to hide the fact that the fuel tank is empty. To understand the trick, you have to understand the difference between eligible and registered. Eligible silver is metal that is sitting in a COMEX-approved vault, but it is not available for delivery against a futures contract. It belongs to someone else. It is private property. It is like a car parked in a garage. Just because the car is there does not mean the garage owner can sell it to you. It is just storage. Registered silver, on the other hand, is the metal that has a warrant attached to it. It is the metal that is available to be delivered to a trader who stands for delivery. It is the inventory on the dealer's lot. It is the only metal that matters for the price discovery mechanism. When we strip away the eligible number and look only at registered, we see a collapse. The registered category has plummeted to levels we have not seen in decades. But here is the smoking gun. Here is the glitch in the simulation that proves manipulation. We are seeing massive sudden movements of metal from the eligible category to the registered category, and then back again. We call this the inventory shuffle. It looks like this. The registered stocks drop to a critical danger zone where a default looks imminent. Suddenly overnight, 2 million ounces of silver are reclassified from eligible to registered. The headline number bumps up. The market breathes a sigh of relief. The crisis is averted. But then 3 days later, that same metal quietly slides back into eligible or disappears entirely. This is not a market functioning. This is a shell game. The vault operators are borrowing metal from private clients just long enough to show it on the morning report, to trick the algorithms into thinking there is liquidity, and then putting it back. They are painting the tape. They are frantically moving the same few bars of silver around the warehouse to make it look like the room is full. But if you track the serial numbers, the room is echoing. The siphon has sucked out the base load, and now they are running on fumes and accounting tricks. The data does not lie, but narratives do. And right now the mainstream narrative is that this is just a supply chain hiccup. They tell you it is a clogged artery or a temporary bottleneck. But a clog clears. A bottleneck opens. We are looking at a spread that has persisted for months and inventory levels that are bleeding out despite higher prices. I want you to go to the comments right now and tell me what you see. Is this just a logistical snarl that clears up next quarter? Or are we witnessing the end of the COMEX as a price discovery venue? Don't give me a maybe. Look at the chart I just showed you and make a call. Logistics or liquidation? Pick a side and tell me why. Because history will remember which side of the trade you were on. Now that we have established the inventory is a mirage. Let us look at the final and most terrifying gauge on our dashboard, the derivative signal. In the commodities market, there is a condition known as contango. This is the normal state of affairs, where the future price of a commodity is higher than the spot price. This makes sense, because if I buy silver to be delivered in 6 months, I have to pay for storage and insurance, so the price should be higher. It costs money to carry the asset. But right now, in key segments of the silver market, we are seeing the opposite. We are seeing backwardation. Backwardation is when the spot price is higher than the future price. It means traders are willing to pay a premium to get their hands on the metal right now, this very second, rather than waiting a month. Why would anyone pay more to get something today if they could get it cheaper in 30 days? Because they do not believe it will be there in 30 days. Backwardation is the market screaming that there is a shortage. It is the panic alarm. It destroys the argument that there is plenty of silver. If there was plenty of silver, nobody would pay a premium for immediate delivery. This signal confirms our Siphon simulation perfectly. The vacuum pressure is so high that the market is breaking the time curve of money itself just to secure physical product. The futures curve is inverting because the future is uncertain. The trust in the delivery mechanism has evaporated. So we have the evidence. The COT report shows the commercials are trapped in a short squeeze of their own making. The inventory shuffle proves that the vaults are running on borrowed time. And the backwardation signal tells us that the smart money is panicking to secure physical possession. The simulation is no longer a forecast. It is a live documentary of a crash in progress. But here is the twist. A machine does not just break like this on its own. A hydraulic system does not develop a vacuum pressure that drains the west and fills the east by accident. This was not bad maintenance. This was not a mistake by a chaotic market. This was a design choice. To understand who built the siphon and why they turned it on at this exact moment in history, we have to leave the trading floors of New York and zoom out to the situation room of the BRICS Alliance, because this is not just about money. This is about war by other means. The Siphon simulation we have been running does not stop at the edge of the commodities exchange. If we widen the aperture of the lens and set the simulation to global scale, the data points form a terrifying picture of geopolitical strategy. We have to understand that silver is not just a shiny rock that people trade for speculation. It is the second most used commodity in the world after oil. It is a strategic metal. It is the blood in the veins of the modern world. You cannot build a Tomahawk cruise missile without silver. You cannot build a solar panel without silver. You cannot build the guidance chips for the fighter jets that protect the Western airspace without silver. So when we see the East willing to pay a $6 premium to siphon every available ounce of physical metal out of the West, we are not looking at a trade. We are looking at a disarmament. The simulation shows that China controls the vast majority of the refining capacity for rare earth metals, and now they are moving to corner the market on the conductive metals that power the future economy. They are weaponizing the supply chain. Think about the irony here. The West has committed itself to a massive green energy transition. We are talking about trillions of dollars in wind farms and solar arrays and electric vehicle batteries. All of these technologies are silver dependent. The politicians in Washington and Brussels are signing legislation mandating this transition, while the bankers in New York and London are suppressing the price of the very metal required to build it. By keeping the paper price artificially low on the COMEX, the West has effectively put its strategic reserves on a clearance sale. We are subsidizing our own conquest. We are selling the bricks of our future infrastructure to our primary geopolitical rival at a discount because we are too obsessed with maintaining the illusion of a strong dollar. This connects directly to the inventory collapse we saw in the previous act. The reason the vaults are empty is not because of bad management. It is because the East understands something the West has forgotten. They understand that in a time of conflict, he who holds the physical asset makes the rules. The siphon is extracting the raw material of war and industry from the West and moving it to the East. When the United States eventually wakes up and realizes it needs 50 million ounces of silver to rebuild its grid or restock its missile silos, it will have to go to Shanghai and ask for a price. And I promise you, the price will not be $30. The price will be whatever the Politburo says it is. This brings us to the BRICS alliance. Russia and China have been very clear about their intentions. They are not trying to destroy the dollar by attacking it head-on in the currency markets. That is a fool's game. Instead, they are rendering the dollar irrelevant by creating a parallel system where paper money cannot buy real things. The $6 spread is the proof of concept. It is the first crack in the dam. They are telling the world that if you want paper promises, go to New York. But if you want metal, go to Shanghai. This aligns perfectly with the massive gold accumulation we have seen from the People's Bank of China and the Russian Central Bank over the last 24 months. They are trading their treasury bonds, which are just I owe us from a bankrupt government for hard assets. They are exiting the fiat system quietly while leaving the door open for everyone else to stay inside the burning building. The Siphon Simulation predicts that their endgame is a trade settlement currency backed by a basket of commodities. Not a currency backed by faith, but a currency backed by grams and ounces and barrels. In that world, the COMEX paper price is not just wrong, it is a laughing stock. So why is the West silent? Why has the Federal Reserve not held a press conference? Why has the London Bullion Market Association not issued a statement regarding this historic dislocation in price? Their silence is the loudest alarm of all. They are silent because they are trapped. If the LBMA admits that the price in London is disconnected from reality, they are admitting default. They are admitting that the fractional reserve bullion banking system, which allows them to leverage 1 ounce of gold into 500 paper claims, has failed. They are trying to maintain a poker face while their hand is completely empty. They hope that if they do not talk about the spread, it will go away. They hope that the arbitrage traders will somehow fix it. But as we established in the first act, the arbitrage is dead. The silence from the regulators and the central banks is the silence of a pilot who knows the engines have flamed out, but is terrified to get on the intercom and tell the passengers. They are praying for a miracle while the altitude drops, and do not think for a second that this high-level geopolitical chess match does not affect you. You might not trade silver futures, but you live in the economy that is being hollowed out. When the price of silver finally snaps to reality to match the Shanghai valuation, it is not just a chart moving. It is the cost of your electronics exploding. It is the cost of your electricity bill rising as the solar infrastructure becomes prohibitively expensive. Worse yet, it is the vaporization of your retirement account. Your 401k is packed with paper assets. It is filled with stocks and bonds that derive their value from the stability of the current financial order. If the West loses the power to price global commodities, if the dollar loses its seat at the head of the table, the standard of living you are accustomed to will be mathematically impossible to maintain. We are not just exporting metal. We are exporting our prosperity. The siphon is draining the purchasing power of your labor and transferring it to a worker in the East. The pieces are all on the board. The West is naked short. The East is long and strong. The inventory is gone. The spread is widening. The media is silent. The trap has been set and the spring is coiled tight. We are standing at the precipice of a repricing event that will wash away decades of financial engineering in a single afternoon. The only question left to answer is not if it will happen, but what it will look like when the dam finally breaks and the water comes rushing down on top of us. We have spent the last 25 minutes dissecting charts and analyzing logistic choke points, but now the investigation ends and the verdict must be delivered. Most analysts looking at this $6 spread between New York and Shanghai will tell you to be patient. They will tell you that markets always revert to the mean and that eventually the price in New York will rise or the price in Shanghai will fall until they meet in the middle. But my conclusion is different. My conclusion will make you uncomfortable because it rejects the very premise of that hope. The spread is not going to disappear. The gap is not a glitch. It is a permanent scar. We are not watching a market that is temporarily out of sync. We are watching a market that has undergone an amputation. You are waiting for the New York price to catch up to reality, but that assumes that the New York price is still alive. It is not. The price you see on the COMEX is a zombie. It is a lingering echo of an empire that has already lost its financial hegemony, but has not yet taken down the sign above the door. Think of the Soviet Union in 1989. The official state exchange rate said the ruble was strong. The official grocery store had a price list that looked very reasonable, but the shelves were empty. If you wanted actual meat or actual bread, you had to go to the black market and pay the real price, which was 10 times higher. That is exactly where we are today. The COMEX is the Soviet grocery store. The price is low, but there is no silver. Shanghai is the black market. The price is high, but the metal is there. This leads us to the most radical truth of this entire investigation. The convergence you are waiting for will not happen through a price adjustment. It will happen through a legal declaration. We are hurtling toward a moment of force majeure. This is a legal term that allows a contract to be voided due to unforeseen circumstances. In the near future, likely over a weekend when the markets are closed, the exchange will announce that due to extreme volatility and supply chain disruptions, they can no longer honor requests for physical delivery. They will not send you the silver you bought. Instead, they will settle your contract in cash. They will deposit $30 into your account for every ounce you thought you owned, and they will call it fair. But at that exact moment, the price of physical silver in Shanghai and on the street will be 50 or $60 or $100. You will be paid out in a currency that is rapidly losing value for an asset you are forbidden from accessing. This is the mechanism of the great theft. It is not a robbery at gunpoint. It is a clause in the user agreement that nobody read. Cash settlement is the death knell of the paper market. It is the moment the illusion shatters, and the holders of paper find out they are not investors. They are merely creditors to a bankrupt casino. We are witnessing a bifurcation of the world. We are splitting into two distinct realities. In one reality, you have the Western financial system built on debt leverage and derivatives. In this world, asset prices are managed to keep the population calm and the currency stable. It is a world of screens and digits. In the other reality, you have the Eastern Bloc and the Global South building, a system based on commodities, energy, and manufacturing. In this world, price is determined by scarcity and physics. You have to choose which world you want to live in. You cannot have a foot in both. If you keep your wealth in the paper paradigm, you are betting that the laws of mathematics can be suspended indefinitely. If you move to the physical paradigm, you are betting that eventually reality always wins. The history of financial empires tells us that this transition is never smooth. When the Dutch guilder lost its status, or when the British pound collapsed, it did not happen because of a polite meeting. It happened because the physical trade moved elsewhere. The center of gravity shifted. We are seeing that shift right now in the silver market. The East is draining the West, and they are doing it because they know the window is closing. They are exchanging overvalued dollars for undervalued hard assets before the rest of the world wakes up. When the waking up happens, it will be panic. It will be a stampede through a door that is already locked. The reason this $6 spread scares the establishment is not because of the money. It is because of the signal. It signals that the West has lost the ability to dictate terms. For 80 years, if New York said gold was worth X, then gold was worth X. Now Shanghai says gold is worth Y, and the market is listening to Shanghai. That is the end of the exorbitant privilege. That is the end of the ability to export inflation. That is the end of the free lunch. So do not look at this chart and see a trading opportunity. Look at this chart and see a clock counting down. The time to acquire position is not when the event happens. The time to acquire position is when the cracks first appear in the dam. The water is trickling through. The engineers are lying. The villagers are sleeping. But you are awake. You have seen the data. You have seen the empty vaults. You have seen the desperate accounting tricks. The verdict is in. The paper price is a lie, and the physical price is the truth, and the divorce between the two is final. This market is not broken. It is being reset, and we are the outsiders looking in at the demolition site. Do not let yourself be buried under the rubble of the old system. If you want to continue dissecting these signals and finding the exit routes before the gates slam shut, then you need to take the next step. This is not about passive observation anymore. It is about tactical preparation. I am building a dossier of evidence and a map of the safe harbors that will survive this transition. Join the community through the link below, not to watch, but to prepare. We do not deal in hope, we deal in logistics. Remember, in the great divorce of financial history, the rules are simple. He who holds the artifact wins. He who holds the paper holds nothing but the broken promises of the past. Elias Thorne, disconnecting.